Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. Previously we've talked about the generation skipping transfer tax, which I abbreviate as GST in this discussion and prior discussions, just because it's a mouthful to repeat generation skipping transfer tax over and over again. But for this episode 63, we're going to dive just into some of the basics of GST-Exempt Trust. Now, I emphasize basics because there's no way I could do this subject full justice in the limited time we have here. But we'll dive into some basics to at least look at when you're analyzing irrevocable trusts. Now, as always, this presentation is not intended to substitute for legal or tax advice. Now, the GST tax has not always been around. It was a new addition in 1985, and because of that, there are some trusts that existed prior to September 25th, 1985, or might have been created and become irrevocable on that date, or if not before it, that are treated as GST Grandfathered Trusts. So no matter what, the GST tax doesn't apply to those trusts, so long as they really have gone unchanged or unmodified since. And there's two ways you could really taint a GST grandfathered trust. One is by having a constructive addition since that time, to which there wasn't sufficient GST exemption allocated to that constructive addition, or you could have bad modifications since that time. Now, bad modifications could warrant its own discussion or multiple discussions in the 10th of an hour, but generally a good way to think of this is, does the modification extend the time for vesting or shift a beneficial interest to a lower generation beneficiary? If either applies, that could terminate the grandfathered status. Now, the good news is that as long as the trust is a grandfathered trust, it is GST exempt. Now, there's a special carve-out from the Gallo wine family for certain types of trusts known as Gallo trusts as well, which are also exempted. Now, if those had been funded with no more than $2 million prior to January 1 of 1990, and if they are created for the sole benefit of one grandchild, now, that's a point that's not in the slide here. I want to drive that home again. For the benefit of one grandchild, then that Gallo trust is also exempted so long as it doesn't go through one of those other bad modifications I talked about, like a constructive addition without GST allocation of exemption, or a bad modification that extends the time for vesting or shifts an interest to a lower generation beneficiary. So if you don't have a grandfather trust, then you get into the question of whether or not you have a GST exempt trust. And really, the goal of planning for a GST exempt trust is to allocate enough GST exemption at the time of a taxable transfer, i.e. a transfer that's subject to estate or gift tax, that you can create an inclusion ratio of 0. So typically, any transfer to an irrevocable trust, you're going to be able to allocate GST exemption to. But there are some trusts to which you can't allocate GST exemption. Generally, revocable trusts will fit that bill, but also some types of irrevocable trusts. And it's not necessarily because of the power to revoke itself or because of powers within the trust, but more because at some point in the future, the assets of that trust could be included in the gross estate of the grantor or a beneficiary. Now, that period of waiting is called an estate tax inclusion period, or ETIP, and the general rule is that you can't allocate GST exemption during that ETIP period. Generally, where you'd see that would be for a trust like a GRAT, where if the grantor dies during the trust term, it could come back into the grantor's gross estate. Now, jumping back to the inclusion ratio, unlike with the gift or estate tax, where you apply your exemption as a tax credit, what happens in the GST world is that your exemption is applied in order to create an inclusion ratio which affects the tax rate. So you have a GST exemption of 11.58 million, which is separate and independent from the gift and estate tax exclusion, but the number is still pegged to those. And the goal here would be to allocate the exemption dollar for dollar to the transfer at the time that gift or estate tax applies. And in doing so, if you have a perfect one-to-one application, you'll have an inclusion ratio of 0, because your inclusion ratio is really 1 minus the fraction, the numerator of which is the allocated exemption, and the denominator of which is the value of the transfer. So if you allocate dollar for dollar, your inclusion ratio is essentially 1 minus 1, which equals 0, and 0 times 40% equals a 0% tax. Now, we don't get into automatic versus manual allocation of the GST exemption. That could warrant multiple discussions as well, but big picture here is, why do we really care? Well, for trusts that are irrevocable and not created exclusively for skip persons, which would describe a lot of multi-generational dynasty type trusts, what happens is that the GST tax is deferred until you know exactly how much is going to a skip person. So you have to have one of two events occur in order to reach that point. One is a taxable distribution, which is just simply a distribution from the trust to the skip person. And the second is a taxable termination, which is a point in time where the interest of all non-skip persons terminate, either due to death or due to the passage of time, and the only remaining beneficiaries at that point would be skip persons. Now, in the case of the taxable distribution, the skip person would have to pay tax on that, which is 40% times the inclusion ratio, which is your rate, times the distribution amount. Now, if the inclusion ratio is 0, then you have a 0% tax there, and that's good news for the skip person. And in the taxable termination, the trustee would have to pay a tax equal to the value of the trust at the time, times the rate, which is 40% times the inclusion ratio. So once again, with a 0 inclusion ratio, you get a 0% tax. And the good news is that the inclusion ratio is not affected by the growth in value of the trust. So if you fund a trust with $11.58 million and perfectly offset it to create a 0 inclusion ratio, and it grows to $50 million by the time there's a taxable termination, you're still not going to have any tax on that growth from 11.58 to 50 million, unless during that time of growth there's a shifting of the transferor. Now, GST exemption is fluid because it's reliant on no beneficiary ever being subject to gift or estate taxes on trust assets. Now, if a beneficiary does become subject to gift or estate taxes, which might be the case if a beneficiary dies holding a general power of appointment, or makes a non-qualified disclaimer, or has a taxable lapse or release of some sort of power over the trust, then at that point that beneficiary would become the transferor, and for whatever portion of the trust that was subject to a gift or estate tax, it would lose its 0 inclusion ratio unless and until that beneficiary applies their own GST exemption to that transfer to once again give it that 0 inclusion ratio. So because of this, in a lot of trusts, especially if the GST exemption is not going to be sufficient at funding, what you can do is have a trust split out into an exempt and non-exempt share. The exempt would have a perfect 0 inclusion ratio, and the non-exempt share would have an imperfect 1 inclusion ratio. And with this strategy, you could look at down the road, could a beneficiary become the quote-unquote transferor with respect to a GST non-exempt share, to then convert it to an exempt share through the use of that beneficiary's GST exemption. Now, if you have a GST non-exempt share, typically you're going to run into the issue that distributions or terminations will be taxable, but there's one important exception to that, and that is the direct payment exception, where if there's a skip person beneficiary and there's a direct payment of tuition or medical expenses from the trust by the trustee on behalf of that skip person, that would not be treated as a taxable distribution, regardless of what the inclusion ratio of the trust might be. So that's a good way to make sure that skip persons could still benefit from a trust that is not a GST-exempt trust. Now, there's lots of other pieces I could cover on this. GST tax takes a long time to master, but those are discussions for another time. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode of the 10th of an Hour, and I look forward to seeing you in the next one.